The next chapter is the design of the tax system. In this chapter, we will learn about the topical policy issues such as the marriage penalty, the flat tax, income versus consumption tax, and the corporate income tax. We're also going to take a look at the difference between progressive and regressive taxes, marginal and average tax rates, and the various criteria for evaluating tax systems. Now, the chapter begins with a financial overview of the U.S. government, and since the topic here is taxation, this PowerPoint presentation focuses on the revenue side. You can find additional information on the spending side of a government budget within the context of the textbook chapter itself. So, one of the 10 principles from Chapter 1 is a government can sometimes improve market outcomes. They can do this by providing public goods, regulating the use of common resources, and providing remedies or remedying the effect of externalities, or finding remedies for externalities. To perform its many functions, the government raises revenue through taxation to finance those activities. There are a few lessons about taxes from our earlier chapters in this text. First being a tax on a good reduces the market quantity of that good, makes the good more expensive, so there's less quantity demanded on the market and quantity sold. The burden of a tax is shared between buyers and sellers depending on the price elasticities of demand and supply. We covered that in the elasticities chapter. And a tax causes a deadweight loss. So taking a look at taxation in the United States, we must consider how the tax revenue as a share of the national income has changed over time, how U.S. tax reserves compare with other countries, and the most important revenue sources. What are in uncovering really what are the most important revenue sources for federal, state, and local governments. Now, the U.S. government receipts, looking at it from 1929 to 2011. Government receipts include tax revenue, contributions to social insurance programs, and income from government-owned assets. So from 1929 to the late 1990s, government receipts increased from about 10%, from about 10% to about 30% of GDP, gross domestic product. Note, however, that the receipts as a percent of GDP tend to be lower in recessions than in booms. That's why you see the upward and downward movement here on the graph, as the graph clearly shows in 2001 to 2002, and again in 2008 to 2009. Since the first 10 years of the data in this graph correspond to the Great Depression, we might get a more accurate sense of the long-run trend if we focus on the period starting after the end of the Great Depression and ending before the Great Recession, which was from 2008 to 2009. So from 1940 to 2007, total receipts increased from 16% to 30% of GDP, which is still a huge increase, but less dramatic than that of the period beginning in 1929 with the Great Depression. So I believe all this information was pulled from historical statistics at the U.S. Bureau of Economic Analysis. Tax revenue relative to GDP varies across countries. For countries included in this table, the U.S. is roughly in the middle. Europe is generally higher, while lower income countries are generally lower. And these figures come from the OECD United Nations data from 2011. So you can see we're kind of in the middle of the pack there. The individual income tax is typically the largest source of revenue for the U.S. federal government. Again, emphasis on federal government. Social insurance taxes, such as that for the fees collected for Social Security, Medicare, etc., Medicaid on a state level, run a close second. So, again, this is from the Bureau of Economic Analysis. Give you a little idea of where the funds are coming from in terms of U.S. tax revenues. The most important revenue sources for state and local governments, again, this was for federal, and this is for state and local governments, are funds from the federal government, so transfers from the federal government, and revenue from sales and property taxes. Income taxes are also important in many states, but not so much on a local level. States really rely on transfers from the federal government and also sales and property taxes. Now, let's take a look at taxes and efficiency. One tax system is more efficient than another if it raises the same amount of revenue at a smaller cost to taxpayers. So you get more at a lower cost. So that's the same in operational efficiency as it is in tax system efficiency. You're more efficient if you raise a same amount of revenue at a lower cost to taxpayers. So the more revenue you can raise at a lower cost, the more efficient you are as a tax system. The cost to taxpayers include obviously the tax payment itself, deadweight losses that we've discussed in previous chapters, and the administrative burden. You have to administer the tax. You have to follow up on delinquent accounts. You have to do auditing, those types of things. So something like the IRS is a huge administrative burden. So let's take a look at deadweight losses. One of the 10 principles in Chapter 1 was people respond to incentives. And you can recall from Chapter 8 that taxes distort incentives and cause people to allocate resources according to tax incentives rather than their true costs and benefits. So there's that distortion again. The result is a deadweight loss. That's a fall in the taxpayer's well-being exceeds the revenue that the government collects. So the taxpayer's well-being, the decrease in the taxpayer's well-being is greater than the amount of revenue that the government collects. So again, the deadweight loss was covered extensively in Chapter 8 if you need to review it. There's a brief example in the text for Chapter 12 explaining the deadweight loss if you want to review that as well. But again, I would encourage you to track back to Chapter 8 if you need to refresh yourself on a deadweight loss. The example in Chapter 12 very clearly recaps the idea of deadweight loss from taxation in the context of a simple example, so you can take a look at that as well. Let's compare the income versus the consumption tax. The income tax reduces the incentive to save. If income tax rate is 25%, 8% interest rate equals 6% after a tax interest rate. So the loss of income compounds over time. So income tax reduces the incentive to save. So if you're losing more of your tangible income due to an income tax, it's going to reduce the amount that you can save. Some economists advocate taxing consumption instead of income. This would restore the incentive to save, and it's better for individuals' retirement income security and long-run economic growth because it's placed on things you consume, things that you electively decide to purchase. So you more consciously pay that tax versus an income tax. There's a nice case study in the chapter, and this slide kind of corresponds with that, and you can see the textbook for a more dramatic example of the income tax disincentives to saving. There's a little more specific example in the reading. Now, a consumption tax like provision in the U.S. tax code includes individual retirement accounts, that's IRAs, 401k plans. People can put a limited amount of saving into such accounts, and the funds are not taxed until withdrawn at retirement, so you defer taxes in that situation. Europe's value-added tax, widely called a VAT, is like a consumption tax. Basically a supply-side focused consumption tax on suppliers. The administrative burden, getting back to what it costs to administer a tax system, this includes the time and the money people spend to comply with the tax laws. So it's your time, your opportunity costs, and the money you spend, say, hiring an accountant to do your taxes or buying software. It also encourages the expenditure of resources on legal tax avoidance. You become incentivized to find ways to exploit loopholes by hiring accountants, attorneys to reduce your tax burden. And this is a type of deadweight loss. So could be reduced. The administrative burden could be reduced if the tax code were simplified, if it was not so hard to comply, if there weren't so many ins and outs. But it would require removing loopholes, which is politically difficult because people fought to get those loopholes there. They're going to fight to keep them in. Now let's take a look at marginal versus average tax rates. An average tax rate is total taxes paid divided by total income. Pretty straightforward. And it measures the sacrifice a taxpayer makes. So how much of their taxes paid is a percentage of their income. Marginal tax rate is the extra taxes paid on an additional dollar of income. Okay, again, there's that word marginal, means one more. The extra taxes paid on an additional dollar of income. So you get another dollar of income, what's going to be my tax rate? And the marginal tax rate measures the incentive effects of taxes on work, effort, saving, etc. So as the marginal tax rate increases, it will affect your willingness to work, because if you're taxed more and more of your hard-earned dollars, you're going to be less incentivized to work. Lump sum taxes. A lump sum tax is the same for every person. It's just a lump sum. Lump sum tax is, say, $4,000 per person. If you have an income of $20,000 or an income of $40,000, this is going to be a different average tax rate, and the marginal tax rate does not change because it's just a lump sum. So 4,000 out of 20,000, average tax rate is 20%. The lump sum tax doesn't change, so there's no marginal tax rate changes. And 4,000 over 40 is 10%, so the average tax rate is 10%. And again, it's a lump sum, so it's not changing. A lump sum tax is sometimes considered the most efficient tax because it causes no deadweight loss. It does not distort incentives and has minimal administrative burden. It's just a simple tax. There's no need to hire an accountant and keep track of receipts, etc. You just pay the lump sum. Yet it's perceived as unfair. In dollar terms, the poor pay as much as the rich, and relative to income, the poor pay much more than the rich. You can look back on this slide here and see that sorry about that. Pardon me. You can see back on here on this slide the lump sum of $4,000 that both someone who earns $20,000, someone that earns $40,000, both pay the $4,000. Well, to the $20,000 earner, that's 20%. That's 20% of their average tax rate is 20% of their pay. Whereas the person who has more money is only 10%. So as you can see, as people earn more, it would be less fair to the people who earn less. So taking a look now more in depth at taxes and equity, another goal of tax policy is equity, distributing the burden of taxes, quote unquote, fairly. Agreeing on what is fair is much harder than agreeing on what is efficient. So we can all try to advocate for minimizing the cost of administering a tax system. However, many different people are going to have many different views on quote-unquote fairness, what is fair for one and fair for another. Yeah, there are several principles people apply to evaluate the equity of a tax system. The first is the benefits principle. The benefits principle is the idea that people should pay taxes based on the benefits they receive from government services. And this tries to make public goods similar to private goods. The more you use, the more you pay. So an example would be a gasoline tax. The amount of tax paid is related to how much a person uses public roads. If you use more gasoline, you burn more gasoline, you have to buy more gasoline, so you're going to pay a higher proportion of the gas tax because you're buying more gas than other people. The second principle is the ability to pay principle. Ability to pay principle is the idea is that taxes should be levied on a person according to how well that person can shoulder the burden. So what is their ability to pay? So this suggests that all taxpayers should make an equal sacrifice. That doesn't mean all equal lump sum. It just means maybe an equal percentage of their income. And it recognizes the magnitude of the sacrifice depends not only on the tax payment, but on the person's income and other circumstances. So a $10,000 tax bill is a bigger sacrifice for a poor person than a rich person. So it's basically a proportional ability to pay. Now, vertical equity is the idea that taxpayers with a greater ability to pay taxes should pay larger amounts. So And again, I apologize. There's a lot of terminology coming at you pretty fast and furious in this chapter. This is a very term-laden chapter, and you can imagine from a testing standpoint, these terms you would possibly have to know the difference between these types of taxes. What is a proportional tax, a regressive tax, and a progressive tax, just to give you an idea of where we might be headed with this. But this is one of those chapters you're basically going to have to study the terms and then know how each tax works. So this is one slide I definitely want you to pay a lot of attention to. So a proportional tax. We're looking at three different tax systems here. The first one is a proportional tax. Taxpayers pay the same fraction of income regardless of income. So it's a flat proportion. You pay the same fraction on your you pay the same fraction of taxes on your income regardless of your income level. A regressive tax is a high income taxpayers pay a smaller fraction of their income than lower income taxpayers. And we're going to go through some examples here of each one that will be a little more helpful. Just think of regressive as regressing back. People pay a larger proportion, poorer people pay a larger proportion of a regressive tax. And then a progressive tax, conversely, is high income taxpayers pay a larger fraction of their income than low income taxpayers. So as people get more money, they end up paying a higher percentage to in tax revenue. Okay, so this slide replicates table 7 from the chapter in the textbook. I should point out that even a regressive income tax satisfies vertical equity, as vertical equity only requires the dollar amount of taxes rise with income, not necessarily the average tax rate. So let's look at the three examples here: regressive, proportional, and progressive. We have three income levels here: $50,000, $100,000, and $200,000. A regressive tax, you will see here, the key thing you're interested in here is what percent of the income is paid by the different earners here. Let's say the lower earner, the middle earner, and the higher earner. Well, the lower earner is paying 30% of their income in taxes. Although the middle earner is paying more than lower earner, their percent of income is lower, and then the person who's the higher earner is only paying 20%. So the lower earner is paying 30% of their income, and the higher earner is paying 20%. So proportional, it's just flat proportion. In this example, we're just saying the proportion is 25% of their income. It goes up as the income goes up, but everyone's paying the same percent of income. Now, progressive, the percent of income gets larger as the individual taxpayer earns more. So regressive, the people earning less pay more. Progressive, the people earning more pay more. And then proportional, everything's equal. So in a test, I could have you label, hey, I could have this blank, that blank, and this blank, and say, hey, which one's regressive, which one's proportional, which one's progressive. U.S. federal income tax rates in 2012. These tax rates, I believe, are in this table are for single filers from 2012. I believe this data would be from the IRS. And you should note when interpreting this table, the tax rates shown are the marginal tax rates that apply only to income in the corresponding brackets. So these income brackets here from $8,700 to $35,000, and so on and so forth. So, for example, a person earning $30,000 would pay 10% on the first $8,700 of their income, 15% on the income above $8,700, and they would not pay 15% on their entire income. So it works on a graduated fashion. So their first $8,700, they're paying a tax rate of 10%. And then from their from $8,700 in this example, I said that they were making $30,000. They would pay up to 15% on that $8,700 to $35,000. So that'd be roughly $27,500 that they would pay 15%, and the first $8,700 they pay 10%. So as you get more and more into the workforce, you're gonna painfully learn about income tax brackets and how that works. So as the table shows, the U.S. income tax is progressive. the more people are earning, the higher they are paying. So it's a progressive tax, the income tax in the United States. This table excludes transfer payments, which accrue mainly to lower income persons. Factoring in transfer payments, the system looks even more progressive. So a good example of a transfer payment may be unemployment, welfare, transfers of funds from the government to the individual. Particularly those of a lower income, actually makes the system more progressive. Let's take a look at horizontal equity. So horizontal equity, you'll hear a little bit more about, is in the real world. That is, you would hear more about horizontal equity. It's the idea that taxpayers with similar abilities to pay taxes should pay the same amount. So the problem here is that it's difficult to agree on what factors besides income determine ability to pay. So there's a great bit of debate. But the idea is, hey, two people earning $50,000 a year and have similar lifestyles should pay about the same amount. So let's take a look at our first activity, which is taxes and marriage, part 1. The income tax rate is 25%. The first $20,000 of income is excluded from taxation, and tax law treats a married couple as a single taxpayer. Sam and Diane each earn $50,000. If Sam and Diane were are living together unmarried, what is their combined tax bill? Again, unmarried. If Sam and Diane are married, what is their tax bill? If unmarried, Sam and Diane each pay 25%. So the first $20,000 is tax deductible, is not taxed, I should say. So their $50,000 minus that first $20,000 is 0.25 times $30,000, which is $7,500. So each of them pay that. If they're unmarried, they pay individually a total tax bill of $15,000, which is 15% of the joint income. Now, if they married, they pay the same quarter with their $100,000 minus the $20,000 that's not taxable, and they pay a 20%, which is they pay $20,000, which is 20% of the joint income. The $5,000 increase in the tax bill is called a marriage tax or a marriage penalty. If there's any increase there, in this particular example, it doesn't necessarily work like this in the real world. That big difference between 15 and 20 is what economists and tax honks like to call a marriage tax or marriage penalty. So in this exercise, Sam and Diane's problem arises because as singles, each enjoys a $20,000 income exclusive, so the first $40,000 of their combined income is excluded from taxes. As a married couple, they only get the first $20,000 excluded. So one way to fix this is to double the exclusion for married couples relative to single tax filers, but doing so causes another problem, as we will see in the second part of this exercise. So this is one example where there's no marriage income tax credit, where we know in the real world there actually is. So let's take a look at part 2. The income tax rate is 25%. For singles, the first $20,000 of income is excluded from taxation. For married couples, we're going to make the exclusion $40,000 in this hypothetical example. Harry earns $0 and Sally earns $100,000. If Harry and Sally are living together unmarried, what is their combined tax bill? If Harry and Sally are married, what is their tax bill? So we're going to find out the impacts here. All right, if unmarried, Harry pays $0 in taxes. Sally pays 0.25 times the $100,000 she earns minus her $20,000 exemption. She pays $20,000. Total taxes is $20,000, and that's 20% of the joint income. If married, they pay 0.25 times the $100,000 minus the $40,000 marriage credit. You get the $40,000 exemption if they're married. That equals $15,000, 15% of the joint income. So the $5,000 decrease in the tax bill is called marriage subsidy. So in all these hypothetical tax situations, it all depends on the policy design. And if the policy is designed to reward those who are single, those who are married pay a what's called a marriage penalty, a marriage tax. They pay the difference. If the system's set up like in this example, where those who are single end up paying more than those that are married, then there's an incentive to get married, and that's called a marriage subsidy. So policy matters, and how you structure the policy matters. Now, in the current U.S. tax code, couples with similar incomes are likely to pay a marriage tax. Okay, if they're both earning a similar amount, that puts them in a higher tax bracket. They tend to pay a little more for pooling their cash. Couples with very different incomes are likely to receive a marriage subsidy, so they're likely to get some money back because they're married. They tend not to pay as much in taxes or get a larger refund, and that can be seen as a marriage subsidy. Many have advocated for reforming the tax system to be neutral with respect to marital status. So that has been an equity argument as to, well, why should I be penalized because I'm single, or why should I be penalized because I'm married? It really should be on an individual basis. So that's an argument that's made quite regularly. Looking at marriage taxes and subsidies continued, the ideal tax system would have these properties. Two married couples with the same total income pay the same tax. That's horizontal equity. Marital status does not affect a couple's tax bill. A person or family with no income pays no taxes. And high income taxpayers pay a higher fraction of their income than lower income taxpayers, essentially arguing for a progressive tax system. So, however, designing a tax system with all four of these properties is mathematically impossible. The first two of these four properties relate to horizontal equity, and the last two relate to vertical equity and also progressive taxation. So, taking a look at tax incidence and tax equity, recall that a person who bears the burden is not always the person who gets the tax bill. So, for example, a tax on fur coats, it may appear to be vertically equitable because people with more money in general have more fur coats, but furs are a luxury with a very elastic demand. The tax shifts demand away from furs because it makes them more expensive, which hurt the people who produce the furs, who are probably not rich. They're trying to sell furs to get their business going. They try to offer it to rich people who buy more furs. So the tax shift has an unintended consequence of hurting the people who produce furs. Or produce a luxury item if furs is not a comfortable example for you. So the lesson here is, when evaluating tax equity, we must take the tax incidence into account, because the tax incidence is going to affect more than just the people that directly is targeting, and has a ripple effect on companies that provide things like luxury goods, if you tax a luxury good. So who pays the corporate income tax? This is a great question. When the government levies a tax on a corporation, the corporation is more like a tax collector than a taxpayer. And here's why. The burden of the tax ultimately falls on people. So suppose the government levies a tax on automakers. All right. Owners receive less profit and may respond over time by shifting their wealth out of the auto industry, so there's less investment. The supply of cars then fall, car prices rise, and car buyers are worse off. See how it runs downhill? Demand for auto workers falls, which means wages fall and workers are worse off. They could be laid off. They could take pay cuts. The corporate income tax is very popular among voters because everybody points and says, yeah, tax the big rich corporations. After all, the corporations are not people. It's easy to point at them and say, hey, let's do that. Voters are always eager to have their taxes reduced and have some faceless corporation pick up the tab. But if the true incidence of a corporate income tax were widely understood, it might be much less popular, because this is going to result in less jobs, lower wages, and higher prices for consumers. So ask yourself this: who ultimately pays that tax? Now, let's take a look at flat taxes, very popular politically. Flat tax is a tax system under which the marginal tax rate is the same for all taxpayers. Typically, income above a certain threshold is taxed at a constant rate. And the higher the threshold, the more progressive the tax. A flat tax sharply reduces the administrative burden because it's flat, it's easy, it's a simple flat tax. It's not hard to administer it to different types of people. However, it's not popular with people who benefit from the complexity of the current system, i.e. accountants and lobbyists and attorneys that make a living interpreting the complex system. It's also not popular with people who can't imagine life without their favorite deduction or loophole. The flat tax is used in some Central and Eastern European countries. Um, this article, I believe, is based on a 2005 Economist article. It's called "The Flat Tax Revolution." If you want to Google that, that's an interesting read. "The Flat Tax Revolution" from The Economist. I believe it's from 2005. That article also appeared in the previous Mankey's previous textbook in the news box. I'm not sure it's in this particular version, but if you want to learn more about the flat tax, The Economist does a great job explaining it in that 2005 article called "The Flat Tax Revolution." So, in conclusion, again, a lot of different things here with the taxes. Yes, you need to be familiar with everything, but you need to know what the different types of taxes are, what horizontal and vertical equity is, regressive taxes, progressive taxes, proportional taxes. You need to know what those things are. So those are some things you're going to have to be familiar with for the test. However, the whole point of this chapter is to relate to you that a tax system is very dependent on how its tax policy is designed. It can have different effects. If you think back to the example with filing single or filing married, it could benefit either the married people or the single people, all depending on how it's designed. So, in conclusion, the trade-off between efficiency and equity, the goals of efficiency and equity often conflict. For example, lump sum tax is the least equitable but the most efficient tax. Okay, and there's low cost to administering a lump sum tax. However, it really affects the lower income people who are paying the same amount as the higher income people. It's a bigger chunk of the lower income folks' earnings to pay that lump sum. So political leaders differ in their views on this trade-off, to put it mildly. In economics, economics can help us better understand the trade-off. At least we can know who are going to be the winners and the losers and who are going to be affected, and make judgments based off that. And economics can also help us avoid policies that sacrifice efficiency without any increase in equity. So you don't want to give up you don't want to give up efficiency if you're not gaining any equity, and you don't want to give up equity if you're not gaining any efficiency. You need to be able to take away from one of them. So in summary, in the U.S., the most important federal revenue sources, again, federal revenue sources are personal income tax, social insurance, payroll taxes like the Social Security deductions you see in your paychecks, and corporate income taxes. The most important state and local taxes are sales taxes and property taxes. The efficiency of the tax system refers to the cost it imposes on taxpayers beyond their tax payments. And one cost is a deadweight loss caused by the distortion of incentives from taxes. Again, you put a tax on a particular good, it raises the cost of that good, and that distorts the market. Another is the administrative burden of complying with tax laws. There's a significant administrative burden to running a tax system. The equity of a tax system refers to its quote-unquote fairness. The benefits principle suggests that it is fair for people to be taxed based on the amount of government benefits they receive. So your benefits principle means you're taxed based on your level of benefit you get under the system. The ability to pay principle suggests that it is fair for people to pay taxes based on their ability to handle the burden, i.e. a more progressive tax. The U.S. has a progressive tax system in which higher income taxpayers face a higher average tax rate than lower income taxpayers. So when evaluating the equity of a tax system, it is important to consider the tax incidence, as the distribution of tax burdens is not the same as the distribution of tax bills. So keep that in mind. Again, the tax incidence example was the corporate income tax, where it said, yeah, let's tax those big bad corporations, faceless corporations. We can tax them. Well, we know that kind of runs downhill in terms of lower wages, less jobs, and higher prices. So who ends up paying those taxes? The tax burden, again, is not the same as the distribution of the tax bills. So policymakers often face a trade-off between the goals of efficiency and equity in the tax system. Much of the debate over tax policy arises because people give different weights to these two goals. Some people lean towards efficiency and others lean towards equity at all costs, and it causes a lot of political debate, and usually the system is designed somewhere in the middle, and it takes a keen economic mind to realize who the true winners and losers can be. So This has been a whirlwind tour of how to design a tax system. If you have questions on this topic, please don't hesitate to send me a message or give me a call. I actually did much of my dissertation on tax systems, particularly in South Carolina, with the property tax. So if for some reason you want to discuss that, feel free to drop by or send me a message. Thank you. Please let me know if you have any questions, and I will talk to you next time.